Roller coaster ride indeed. Take a look at these gaudy numbers. The stock market took another nosedive today. The Dow Jones lost nearly 1,200 points. By that metric, it was its worst day ever. It closed down 4.45%, the largest percentage loss in 2 years. It's been a rough week on Wall Street as fears over the coronavirus create uncertainty in the global market. But why does a virus, mostly half a world away with only a few dozen U.S. cases, affect our economy so much? Let's connect the dots.
It's all about fear of the unknown. I would say fear not.
That's financial planner Lane Martinson. He's not too concerned over the stock market's recent dip. Investors are selling stocks over fears the COVID-19 virus will spread in the United States. Microsoft, PayPal, and Apple are among the major companies to announce they'll miss sales targets because of the virus. Our economy is more global than ever, and the massive quarantines in China affect the bottom lines and production schedules of those blue-chip behemoths. But in uncertainty, Martinson sees opportunity.
I would not feel panic at all. I would actually feel some excitement about there's an opportunity to buy.
Most serious investors have a portfolio that includes more than just stocks. U.S. markets are volatile, but trend upward over time. So if your investments are diverse, a temporary dip in the stock market won't matter much in the long run. And you can score some stocks at a rare discount right now.
It's going to rebound. There's too many reasons for it not to.
10-year Treasury yields are at historic lows. Oil prices have dipped below $50 per barrel, and stock values are consistently increasing. All signs we're still in a bull market, giving Martinson confidence our economy will be just fine. And that's connecting the dots.
For a little perspective, typically within 6 months, stocks recover most, if not all, losses blamed on the spread of disease. That was the case after cholera, Ebola, and Zika outbreaks over the last decade.